Okay, so in our last video, we ended where I was talking about the balances in an account. And we were using T accounts to demonstrate how to calculate the balance. So we're just going to practice a little bit. So let's first start, we'll just work on this one, accounts receivable. Let's say we include a date typically, let's say on January 5th, we perform services, computer services for a customer, and they owe us $3,000, right? If our customer owes us $3,000, we are going to debit accounts receivable. Let's say then on February 19th, we perform services and our customers have not paid us yet, but they owe us $1,500. That's also a debit. However, on February 20th, oops, sorry, I should actually add a column here. On February 20th, we receive payment. The customer that owes us $3,000 paid us $2,500. So that's almost paid off. And this February 19th is still outstanding. What is the balance in the accounts receivable account? Well, the sum of our debits is $4,500. The sum of our credits is $2,500. The debits exceed the credits by $2,000. So my balance is $2,000. Okay, that's how you do it. If we do it again with utilities payable, let's say I have a bill come in the end of January and I owe $750 for my electric bill. Let's say January 30th. Right? And then I get another bill much earlier for a water bill on February 3rd. And I owe the water company $450. Okay, I record those. Remember, utilities payable is a liability. A credit helps that account to increase. There's a step which precedes this, by the way. We're going to learn it next. So on February 5th, let's do this, right? Let's say I pay my bill for $750, okay? And that's all I've got going on right now. So what's the balance in utilities payable? Well, my debits are $750. My credits are $1,200. And the difference is $450. That's my balance. Okay. That's how you calculate the balance in a T account. Okay. Moving on. Now we are going to learn. In chapter 1, we used the accounting equation and we wrote transactions underneath, asset, liability, how much it was going up and down. And we made sure that equation was in balance after every transaction. But like I mentioned to you in that video, that's not how we actually record financial transactions in accounting. We're about to learn how you actually do record financial transactions in the accounting world. There is something called the accounting cycle, and we're going to begin it here in chapter 2. We'll complete it in chapter 4. So over the next couple of chapters, I will draw this cycle and I will add a few steps in each chapter until we close the whole cycle up. So the first part of the cycle is the first item here. Let me just tap on this. Called source documents. It's hard to write on this little artist pad, right? Source documents. What does that mean? A source document means that if I'm in business and a transaction occurred, I will have some sort of support for the transaction. I will have a receipt. I will have a customer's orders. I will have a deposit slip from a bank. I will have my bank statement. There's something that tells me what transaction took place. So if I, for example, buy office supplies, I'm going to have an invoice from the office supply company. It'll come across my desk, the junior accountants, and they'll say, oh, we bought office supplies, the amount of $400. Okay, so that's the first thing you do is examine source documents. So when you get the source documents, you're going to evaluate them and you're going to say what accounts are affected. Did those accounts increase or decrease? Once you do that, the next step in the accounting cycle is to prepare a journal entry. Okay, so that's what we're going to learn. We're going to prepare journal entries, and then after the journal entry, we post to the ledger. Now we've seen a little bit of that right now. We've looked at T accounts. That's an example of the ledger page. And we've learned how to record in the ledger and how to find the balance in the ledger. So we're going to back up a little bit and look at the first couple of steps. Okay, the first transaction, there's 17 transactions here. Let's see what we get through. The first transaction, I'm going to go back. It's giving you a description. So for classroom purposes, we don't exactly have source documents. The description they give us is considered, we have read the source documents and we know what to do. So number one, on November 1st, the e-learning company received $30,000 cash from Sheena Bright, and the business issued common stock to her. We saw that already happened. So what accounts, first you ask yourself, are being affected? Cash is being affected because I'm getting $30,000 cash into the business. And remember, this is from the point of view of the business. The business gains $30,000. Cash is an asset. So we debit assets to make them increase. The other account, if we look over here at this list, is common stock. Common stock represents owners and ownership interest in the business. That is also going up. Someone bought into the business. Common stock is increased with a credit. So I'm going to tell you the number one rule when preparing journal entries. You always, absolutely, in the entry, your debits and your credits in a transaction must equal. So let me show you what that means. Here's a journal. This is a snippet from another document called the journal. This is where all journal entries record in chronological order the financial transactions that have happened in a company. So November 1st, we debit cash. A debit is on your top line to the far left margin. That's how, when you read a journal entry, you know it's a debit. So we're debiting cash, meaning it's going up. The description of the account is here, and then over here in our little area with debits and credits, we drop the $30,000 under debit to show that cash goes up $30,000. Common stock is our credit. Remember, we just saw common stock goes up with a credit. It's on the next line down. After you list your debits, it's slightly indented, the name of the account, and you carry over the amount into the credit column. Okay? Debits are $30,000, credits are $30,000. That's in balance. Therefore, my accounting equation will be in balance. That's how you prepare a journal entry. Let's try another one. Okay. Actually, went a little backwards. Hang on a second. Okay, before we go on to the next one, let's look at this. So we did the journal entry. That was the second part in the cycle. And then here, we've already learned about T accounts and ledger pages. You create the journal entry, then you post to the ledger. That's the terminology. So what does that mean? Well, you go to the ledger page for cash and the ledger page for common stock. They're in a different vehicle. And you post the amount. Cash receives a debit of $30,000 with the date, and common stock ledger page receives a $30,000 credit. Okay. In the ledger, our debits aren't equal to our credits for each account. It must be so in the journal. Okay. And this just proves our equation is still in balance. Okay. I'm going to end this video right here.